Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. With this stock, you have to take the good with the bad. It seems like a very apt platitude after holding Tesla for 5 years, and I'm somewhat a messenger trying to evaluate the future of this company, but bringing bad news can be an unpopular stance, especially if the news is telling people that they may lose money, be it just temporarily. But if I think Tesla is going to go through some bad periods, then I'll tell you, and I'll tell you why in as much detail as I can as to why, so you can make up your own mind based on the same information I am using. I think long-term Tesla will do exceedingly well, but just look at the stock graph. The ups and downs have been crazy, and I think it would be naive to think that these volatile turns in the stock price may not continue. Therefore, if you're trading or still accumulating your position, then I think it is good to know if Tesla may have a down period, like how I think Q2 may play out. However though, we also have Q4. Now, we know Q2 will be tough due to the China shutdowns and the expense of running these new factories before they hit volume production, and of course the delay with the 4680 production, but it sounds like Tesla Shanghai is going to make up for its downtime, and then some. In fact, Elon gave us some numbers on the earnings call, enough information to get a good idea of just how many units we might expect by the end of the year. Just to quote what Elon said on the earnings call. So I think, notwithstanding with new issues that arise, I think we'll see a record output per week from Giga Shanghai this quarter, albeit we are missing a couple of weeks. So that means that most likely vehicle production in Q2 will be similar to Q1, maybe slightly lower, but it's also possible we may pull a rabbit out of the hat and be slightly higher. But it's roughly on par, but then Q3 and Q4 will be substantially higher. So it seems likely that we'll be able to produce over 1.5 million cars this year. That's my best guess. That was a very underrated statement. Elon is saying Q2 production might be lower in Q2 than Q1. Q1 production was 305,000, so perhaps Q2 might be only 300,000, and perhaps deliveries will be around that as well. Q1 deliveries were 310,000, so if you add those up, we're at 610,000 deliveries for only the first half of the year. If Elon thinks it's likely they'll produce over 1.5 million cars for the year, then that would mean they expect to produce 900,000 for the second half, or 50% more than the first half. Well, that would be in line with what Elon said, Q3 and Q4 being substantially higher. Now, I would guess that Q4 is also a bit higher than Q3, given the fact they'd be ramping. I think it would likely mean that Q3 is around 400,000 and Q4 around 500,000 units. Wow, 500,000 units in Q4, that seems amazing, and this is what's being said. Not only that, Elon also said, yeah, 4680 output is not a risk to achieving 1.5 million vehicles produced this year, but it would become a risk next year if we do not solve volume production by early 2023, but we're highly confident of doing so, implying that this level of production can be achieved without even 4680 cells being ramped up to volume production. Therefore, we could take a cross-section of Tesla at this stage and place a valuation on the company. What exactly are we trying to value here? I think a valuation of Tesla without 4680 cell production ramped. Elon seems confident they can achieve it by this stage, or the following quarter at the latest, but in case it does take longer and the market overreacts, let's try and establish a more intrinsic valuation of the company in case, for example, the market did overreact and crush the stock price. Then we would know the value of Tesla still and have the conviction to purchase the stock at these potentially low prices. The trick here is going to be to establish the run rate of these new factories and the actual cost of running them. Despite all the modern manufacturing processes the new factories contain, it's possible we're not using them yet and still having to resort to the old techniques as a backup due to 4680s being delayed. Another important quote from Elon was, "We also have, just as a risk mitigation, 2170 non-structural pack capability here at Giga Texas as well. But if things go according to plan, we'll be in volume production with 4680 sometime perhaps towards the end of the third quarter and certainly in the fourth quarter." So that implies that Texas may have to resort to non-structural 2170 packs possibly. I mean, it does sound like Elon is confident the 4680 production will ramp up, but I want to value the company based on Q4 without 4680 being ramped and Tesla having to resort to 2170 cells in both factories. I think this is good to assess the downside. Yes, I'm a Tesla bull and I can do crazy valuations as well, but I also like to know my level of exposure to potential risk as well. Therefore, I think it will be necessary to get a breakdown of each model from each factory to try and evaluate the earnings Tesla may be generating by the end of this year. If the 4680 line has not yet been successful to the levels we hope, allocating 500,000 cars in one quarter is actually not easy. It's a lot of vehicles. I've placed 150,000 in Fremont. up from around 120,000 in Q1. Elon has said they expect Fremont to increase production still. I'm going to place both Texas and Berlin at volume production, totaling 60,000 units each. That is plenty of time for those lines to reach volume production, based on the history of Shanghai. I expect most of the growth to still come out of China, especially without 4680 cells. However, this leaves an insane 230,000 units out of China in order for us to reach 500,000 units total. Now, Elon did say China will come back with a vengeance. I get the feeling China is being more sandbagged than already. I think they can already hit a 1 million vehicle annual run rate there. And it will come down to the batteries, which are coming from CATL, and it sounds like they will have plenty by that stage. Elon didn't actually mention anything about being chip constrained anymore on the earnings call. Anyway, that gives us a rough breakup of what will be produced and where if we have a 500,000 production quarter in Q4. I'm going to use today's prices for the average selling price. I'm placing Berlin higher as it could still be Performance Model Y they're selling there. I'm placing the Austin one lower as we don't really know what they would be selling there, and if it's 2170 model, it might be the long range or performance version. But as this is more of a bear case scenario, I'm going to lock in the lower price. That generates $30 billion of revenue. I'm then going to assign the margin I think each factory will be producing for each model. Now, in this model, we do get to use the new price increases. Now, according to my research, it looks like Tesla did have some long-term contracts for a lot of their raw materials. Therefore, I think that the price increases are also going to mean some margin has increased too. In other words, I think Tesla have raised their prices more than their costs have increased. And Zach Kirkhorn on the call said, we do have higher ASPs in our backlog, which will help to offset some of these headwinds, implying they are expecting higher margins on the high ASPs when they do kick in, and they would have all kicked in by this stage. However, we need to also factor in the two new factories. Now, if they hit volume production, which we're saying they have, then I think they could reach a margin of around 22%. Remember, we are likely not factoring 4680 cells, structural pack, or possibly not even front castings. We haven't seen the next evolution of cost savings in this scenario. When Tesla was ramping up the Model 3 line to volume production, we had total margins down to around 20% during this period. That was being subsidized with Model S and X too. I'm guessing that these facilities do cost a lot less to run relatively than when compared with California though, and Tesla need to produce fewer models to break even. Anyway, this could be debated as to what margin they should be seeing, but at a guess, this level of production is still adding to net profit rather than taking away, which we would have expected to happen in Q2 and possibly Q3. This comes in at 8.8 billion gross auto profit. We'll just go through the rest of the valuation reasonably quickly. When we add FSD and credits, we come to a total gross revenue of over $30 billion. This equates to a 31.6% gross margin. Compare that with 32.9% from Q1. I think if Tesla hits this, then they've really caught up and not let the new factories affect earnings too much. Of course, we don't know what the margins have been like for what could have been a more difficult Q2 and Q3. The other sides of the business are likely still not affecting earnings in any major way, and I've assigned where I think OPEX might be at this stage. With a reasonable rise in SG&A, this all ends up at a net profit of $6.7 billion, or around $27 billion annualized. Now, as this is somewhat a bear case we're presenting here, then we're not expecting to have any other major breakthroughs in technology like FSD that could shot up the stock price. So we'll try and keep a more focused PE ratio to bear that in mind. Equally, at this stage, we're still not seeing the 4680 line ramped, and perhaps Elon is saying it might not be until later in 2023, as in we do not yet see the signs of Tesla going to the next level. Therefore, if this is the case, it should be somewhat disappointing. Today's valuation of the stock price is about 70 to 80 times the annualized figure of the Q1 earnings. If things have not progressed much from there, I think even a PE ratio of 50 relative to the quarter might be more likely for Q4, excluding what any macro issues might have done in the markets. I'm not trying to predict macros or black swans. I'm not Nostradamus. Either way, I think that would equate to a stock price of around $1,300. I mean, we're still talking about double growth in earnings from Q1 to Q4. The market will see that and realize the growth is still coming. They may not be so aware with the potential issues of the 4680s if they're not ramped up soon from there, as in the growth of the company will slow significantly without them. Anyway, I think that should mean Tesla hit a stop price of $1,300. Now, this is not my price target. My price target is $1,500 for the year. This is me doing my best to estimate a stop price based on the events I've mentioned occurring. I think another way of describing these events might be the stop price Tesla will reach when the factories are ramped up to absorb all current battery supply that's not in-house, aka 4680. This is the largest Tesla can grow with the previous technology, It will take the 4680 and structural battery packs to level up the company to the next level of exponentials. This is still a 30% increase from now until the end of the year, which is still a great return. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.